Good morning, everyone. I'm Saisha on behalf of Kirin Advisors. I welcome you all to the Investor Conclave, Investor Connect Summit 2026, powered by Avinash Mentor and co-powered by Kirin Advisors. Today marks second day of our today's summit, featuring a powerful lineup of focused management meetings. I welcome you all to the interaction with Current Infraprojects Limited. From the management side, we have with us Mr. Sunil Gangwar as Chairman and Managing Director. Hello, sir.
Hello.
Mr. Chetan Dadej as CEO. Hello, sir.
Hi, good morning, everyone.
Mr. Manish Sharma as CFO. Hello, sir.
Hello, good morning, all of you.
And from Avinash Mentor team, we have Ms. Bhargavi. With that, now I hand over floor to Ms. Bhargavi. Over to you, Miss. Before we start the session, let's have a quick overview about the company. Current Infraprojects Limited is a Jaipur-based infrastructure and renewable energy company established in 2013. The company operates primarily in the engineering, procurement, and construction segment, delivering end-to-end solutions across electrical infrastructure, solar energy, water utilities, and civil infrastructure projects. With that, now I hand over the floor to the management for a brief overview. Over to you, sir.
Good morning, everyone. I am Sunil Singh Gangwar. A warm welcome to all investors, analysts, and stakeholders joining us today for the Investor Conclave Investor Connect Summit 2026. On behalf of the management team, I sincerely thank all of you for your continued trust and support in Current Infraprojects Limited. Current Infraprojects Limited has undergone a remarkable transformation since its inception in 2013, evolving from a specialized electrical contractor into a diversified EPC company with capabilities across power distribution, railway solar, utility shifting, solar resco, and renewable energy solutions. Our journey has been driven by a clear vision of building a company known for execution excellence, engineering strength, and long-term value creation. Over the past few years, we have focused on three strategic pillars, namely execution excellence, capital efficiency, and business diversification. This disciplined approach has enabled us to expand beyond Rajasthan and establish a growing presence across multiple states while strengthening our position as a trusted execution partner for government utilities and leading infrastructure developers. FY26 marked a defining milestone in our journey with the successful completion of our IPO, which received an overwhelming response from investors. The strong investor participation reaffirmed confidence in our corporate governance, execution capabilities, and long-term growth strategy, while strengthening our balance sheet to support future expansion. Operationally, we continued to build strong momentum across both our infrastructure and renewable energy business during the year. We secured electrical EPC work orders worth approximately 110 crores from Jaipur Vidyut Vitran Nigam Limited and Jodhpur Vidyut Vitran Nigam Limited under the RDSS scheme, providing healthy execution visibility and coming years. Recently, I'm very happy to inform you, just few days back, we were L1 rather in another Jaipur Discom tender valuing 22 crores. Yes, work order is yet to be received, but we were L1. In renewable energy, we successfully commissioned our RESCO solar power plants, including projects for Jodhpur Discom and IIT, which was uh, originally ISM Dhanbad. These projects have strengthened our renewable energy asset portfolio while creating stable annuity-based revenue streams through long-term power purchase agreements. We also remain focused on emerging opportunities battery energy storage systems, which is BESS, as the industry increasingly moves towards integrated energy solutions. Alongside our project expansion, we have continued to strengthen our internal engineering ecosystem. Our team of over 45 certified engineers, supported by our in-house NABL accredited MEC test lab, enables us to maintain high quality standards, faster execution, and greater operational reliability across projects. India's power infrastructure sector presents significant long-term opportunities, supported by rising investments in transmission networks, renewable energy, rural electrification, railway infrastructure, and grid modernization. With our diversified capabilities, a healthy project pipeline, and an expanding geographical presence, we believe Current Infraprojects Limited is well positioned to capitalize on these opportunities while delivering sustainable long-term growth. Coming to the financial performance, the company delivered a strong performance during both H2 FY26 and FY26, supported by robust project execution across infrastructure and renewable energy segments. For H2 FY26, the company reported total income of rupees 116.48 crore, registering a strong year-on-year growth of 153%. EBITDA for the period stood at 15.71 crore with an EBITDA margin of 13.56%, where profit after tax came in at rupees 10.16 crore with a PAT margin of 8.76%. Earnings per share for the period stood at 5.63. The strong operational performance was driven by accelerated execution across ongoing EPC projects, improved operational efficiencies, and higher contribution from renewable energy projects. For the full year FY26, the company reported total income of 161.35 crore, reflecting a healthy year-on-year growth of 77%. EBITDA stood at rupees 23.23 crore with an EBITDA margin of 14.48%, while profit after tax increased to rupees 14.05 crore, translating into an EPS of rupees 8.31. The strong annual performance reflects higher execution volumes, improving operating leverage, and sustained focus on the cost discipline across projects. Looking ahead, we remain committed to disciplined execution, prudent capital allocation, operational excellence, and creating long-term value for all our stakeholders. With a strengthened balance sheet, a robust order pipeline, and expanding capabilities across infrastructure and renewable energy, we are confident of sustaining our growth trajectory in the years ahead. I would like to sincerely thank our shareholders, customers, employees, project partners, lenders, and all our stakeholders for the continued trust, confidence, and support. Thank you. That's all from my side.
Investors, now floor is open for Q&A. You can raise your hand or you can drop your questions in the chat box. Investors, now floor is open for Q&A. You can raise your hand or you can drop your questions in the chat box. So we have a question in the chat box. Approximately what percentage of FY27 revenue is already secured through existing orders?
In FY26,
FY27.
They are asking about 27. So financial year 26-27, yes, we have already sufficient orders in hand for our targets for financial year 26-27. So this is 100% secured from the existing orders.
Your order book has crossed 305 crore. Historically, what percentage of your order book gets converted into revenue within the next 12 months?
See, in general, we considered a project which is more than of 20 or 30, 40 crore rupees for a period of 15 or to 18 months. But the projects having less than value of 20 crores is generally having a completion period of 1 year. So if you will ask particularly the percentage of your order book gets converted into revenue within the next 12 months, so it will be around 80% or the 75% of the total order book, which will be converted into revenue for the within the next 12 months. Maniji, are you playing?
Incoming call from Shamvik Singh signal identified by Truecaller.
hello. Can you repeat your answer, question?
Following the IPO, your leverage has reduced significantly. At what debt to equity level would management be comfortable operating while pursuing the growth?
After the IPO, our debt equity ratio below 1, maybe 0.5. But recently we received many orders from the government projects as well as private projects. For completion of these projects, we need more funds. So we approach more debt in future for completing these projects.
What is the minimum annual order inflow required to sustain your current growth trajectory beyond FY27?
Okay. So if you see our targets for upcoming financial year 27, 28, 29, so we feel that the order book around 400, 500 crore will be very good for us to maintain the current growth trajectory beyond financial year 27. And so on, definitely.
What percentage of the current order book carries fixed price contracts versus price variation clauses?
Okay. So generally, the government projects generally contains the price variation clauses. However, if there is a completion period of less than 6 months or less than 4 months, so in generally this kind of contract doesn't have the clause of price variations. And in terms with the private contracts, we try to get this price variation clause in our contract if the contracts goes beyond 12 months. But yes, generally private players discourage this kind of clauses in the contract. So we quote our prices accordingly. If you will see, ask about the percentage of total order book, so it may be around 40, 35, 40%, which will be having the price variation clauses as on date in our orders.
Yes, Ms. Bhargavi, please go ahead. So your revenue from operations achieved an outstanding 76% YOY growth, rising to rupees 160.4 crores in FY26 from rupees 90.9 crores in FY25. So what specific multidisciplinary or multi-state infrastructure or solar mandates drove this massive top-line acceleration? And what run rate can investors expect from 2000, FY26, 27, sorry?
You asked 2, 3, 4 questions combinedly in this question. So try to segregate all these questions. We are asking about the mix of solar and all other contracts in your first question. I believe this is right.
Yes, sir.
Okay, so if you'll see the turnover bifurcation between all the segments of our company. So in the solar EPC, we did around, I believe, 50% of the total revenue in the last financial year. And in electrical and other segments, it's electrical will be around 25%, and then water will be around 15%, and other segments will be having some balance works. So if you will ask about the expectation in this revenue mix for the coming financial year 27-28, so we believe that electrical and solar will be the top revenue scorer in the financial year 27-28 will be there. So if you will ask about the percentage, it will be around 60-70% combining from these two segments in the coming financial years.
Okay,
and
sir.
you asked about the last one is what is your exact question for the last line?
Run rate.
Okay,
Run
so run
rate
rate.
can, yeah.
See, the run rate will be depending on the total turnover targets. So if we are targeting a revenue mix of 250 crores or maybe around that figure in this financial year 27. So the run rate will be around the same. The 60-70% I already told about the electrical and solar EPC works.
Okay, sir.
Yes.
Also, sir, I have one more question. Your
Yes.
solar EPC segment grew exponentially, roughly fourfold, to achieve rupees 96 crores in revenue during the FY26. Do you expect solar infrastructure to officially overtake civil and utility engineering as the company's primary revenue anchor in FY27?
Yes, we are targeting for that. Because see, the solar and BESS is the future for upcoming 3, 4, 5, 6, 7 years in India. So if there is a lot of opportunities in this segment, so we are ready for that. So why not to take more works in this segment if the works is available in the market on a good margins and like with a reasonable completion periods and having as per our suitability of the company.
Thank you,
Yes.
sir. Investors, you can raise your hand or you can drop your questions in the chat box. So, if government tendering slows for 2 or 3 quarters, how much revenue visibility do you currently have?
Tendering slows for 2 or 3 quarters, how much revenue visibility? See, as I already told that the current financial year, we have already secured our works. We have already an order book of 305 crore rupees, and we are targeting just 250 crore for this financial year 27. So if the government tendering will be slowed down for another 1 or 2 quarters, so there will be not a major impact for us. But yes, we are continuously participating in the tenders, and as on date, again, we have participated in a lot of government tenders. So this question looks like theoretically as on date, because we have already participated in a lot of tenders as on date. Yes.
And
If
government
larger
tendering is
EPC
not going to slow down.
Yes, sir.
The government tendering, I believe, is not going to slow down as in next 20 years,
Yes, obviously.
India infrastructure is going to grow like anything.
If larger EPC opportunities require higher working capital, would your preference be debt financing or equity dilution?
See, we all know that equity is always be a costlier mode to any entrepreneur for getting funds. But yes, if we will be requiring more working capital in the coming years, coming days, so definitely we will be planning some balance solutions from debt and equity as per the suitability of our company. We are open for this, yes.
Have you witnessed any project cancellation or major scope reduction over the past 3 years?
See, if you will ask any particular example which we have faced in last 3 years, so I would say there would not be a significant situation like this. But yes, since these are the contracting trades, so there is always the probability of witnessing such kind of situation. But yes, we are always vigilant in our business that how this will be impacting our profitability and other things.
With the government's continued emphasis on infrastructure development, which sector do you believe will witness the strongest tender activity over the next 2 years?
If you see the past record of our business, the electrical and solar EPC segment contributes the largest share in the revenue. So similarly, we believe there will be a lot of opportunities in this segment, renewable and electrical segment, in the coming years. So these two sectors will be the topmost scoring sectors in our business mix for coming financial years. And yes, we are continuous doing business in all of our segments, which you have already quoted, 3, 4, 5 segments from last 3, 4, 5 years. You will see the revenue mix. So we are continuously doing business on all the segments. But the top segments will be solar and electrical.
Can you quantify how much of the executable order book, executable order book is linked to government projects versus private sector's project? And does this affect the pace of revenue recognition?
See, if you will ask the quantifiable in percentage, so I will share like the government project is sharing around 40% of the total order book, and the rest 60% is from the private players as on it.
What is the expected timeline for completion of this order book pipeline?
Another 12 to 15 months, majorly.
Investors, you can raise your hand or you can drop your questions in the chat box. Has the rise in steel, cement, and labor cost stabilized, or do you still expect margin pressure?
We all know that the war is now almost end, and the prices are now being corrected from last 15 days. So we are expecting some more corrections in the prices in the market, as we are already in touch with the market experts of steel and aluminum and copper. So they all are expecting some price corrections over here. So that will be going to increase our profitability from the current scenario. Yes.
Solar EPC has become your largest revenue contributor. What percentage of this business is repeat business versus first time customers?
This is a repeat business. See, in CIPL, we are very lucky to have repeated orders from our all customers. If you see the order book, you always see that the all customers is our old customers. So, what percentage of the business is repeating? Except government tendering, for the private one, 100% repeated orders we have, and for the government, we always have to fight the tenders. So yes, JVNL is our old customer, JDVNL is our old customer. So all the government customers which we have in our cartel, we are continuously bidding for them. But the government tendering is purely depend on the annual prices. So if you will say as a layman that we are getting repeated orders from our customers, so yes, we are getting repeated orders from our all customers, whether it is private, whether it is government.
What are the management's top three priorities over the next 12 to 18 months that investors should monitor?
If I'll say the top three priorities, one is the revenue growth. Definitely, we are very aggressive on this part. We are continuously doing tendering for getting more and more projects in upcoming months. And we are very aggressive now in government tenders. So the first priority as on date with our in our management is to get more government contracts, which the investors can continuously monitor. And as a part of this monitoring, you can see the tenders which have already submitted as on date. If you will go with the second priority as on date, we are trying to increase our profit margins. See, if we will be growing our total top line, so we have a proportion of fixed and variable expenses, as all companies have like this only. So we are very vigilant on the variable margins, which we can get increase in this financial year or the upcoming financial year by increasing our top lines. And the third priorities is we are very much aware about implementing our internal policies. Because of that, we will be only able to deliver more projects professionally and perfectly.
Your H2 performance suggests sharp growth. Do you think the company will sustain this brisk pace of growth? And what factors do you think will help the company to maintain the strong growth in the near terms?
See, for any infrastructure company, the H2 is very important. Not only for us, if you will see any infrastructure company in the market, you will see the H2 will be contributing high volume in compared to H1. So yes, this is the trend in our business because every contractor or every client has to bill his up-to-date work on 31st March. So the quarter 4 out of all quarters is again a very important quarter for any infra player. So yes, the H2 performance always be having some sharp growths in compared to H1 or in compared to the last quarters for our company or for any infrastructure player.
Which government initiatives are expected to create the biggest opportunities for the company?
As on date, PM Surya Ghar, we are targeting very aggressively. So what we believe is PM Surya Ghar is having a big potential for us. If you will see a news, there will be a news in newspaper around 15 days back. So the Rajasthan is on the 6th number as on date. So we believe PM Surya Ghar has a big potential as on date in the market. So we are targeting this government initiative very aggressively in this financial year. And we expect a good business mix from this particular scheme of government in this financial year.
And I believe very soon government will focus on BESS. So in the next financial year, BESS government policies will come very strongly in favor of BESS. So we have begun to learn. We are tendering in BESS. So next big thing is BESS as far as government is considered.
If 35% of the order book is protected through price variation clauses, how do you manage commodity price risk on the remaining 65% of fixed price contracts?
See, I already told you if we have a contract of less than 6 months. So what we do is we generally freeze all raw material prices on day one with our suppliers. And we try, because see, if in any infra projects, there is a stage billing. If we supply the material, we bill it for 80% or 75% as per the contract terms and conditions. So we focus on those scenarios also where the price variation risk is open in the market. We generally try to freeze those materials on a day one so that we can secure our margins. And accordingly, if I already told you that government projects has the clause of price variation over there. So it minimizes our risk in the market against the open price fluctuations.
How much of your solar pipeline depends on PM Kusum and what and other government schemes versus private sector demand?
See, I believe this question is more about the solar. If you will ask the PM Kusum projects, we already commissioned out 3 PPAs under the government scheme of PM Kusum, and we are getting monthly fixed revenues, almost fixed revenues from all these 3 projects. And these 3 projects have been commissioned in our SPVs, and I believe these SPVs for PM Kusum is particularly contributing around 5 crore rupees, 4.5 to 5 crore rupees per annum in our company. And if you will ask about the government scheme versus private sector demand, particularly in solar. So for EPC, we are open for government and as well as the private contracts. And as on date, we are doing a lot of private contracts and a lot of government tenders for EPC, for solar business particularly. If you will see the clientele, we have a big client in KNY in Delhi, and for the other like government clients, you will see the Indian Railways are there, BSF is there. So these kind of government clients for which we are doing the solar EPC as on date.
Do you expect solar EPC margins to remain sustainable as competition increases and project sizes becomes larger?
See, if the project size becomes larger, the variable cost will be definitely, the fixed cost will definitely be contributing in increasing the margin for us. If I am doing a project of 10 crore and I am doing a project of 100 crore, the fixed cost is almost same for both. So if the project size will increase, there's a high probability of getting some good margins. But yes, competitions are there. In general, what we are doing as on date is we generally doesn't quote in below or beyond the lower level of the calculations as on date. So we are very particular about protecting our margins. And yes, we believe we will sustain the margin percentages which we are getting as on date.
Is the 50 crore order inflow sufficient to maintain your current revenue growth trajectory, or would you need a higher run rate of order wins to sustain FY27 and FY28 growth?
See, as on date, I could not say any figure for this, but definitely this 50 crore is nothing for us. We will see a big values over here to sustain the business for 27-28. And I believe that these big values you can see in this finishing value.
What is your revenue guidance for next fiscal year and margins expectations?
Okay. So for the current financial year, 26-27, we are targeting around 230, 40, 50 CR for this year, financial year. And for the next financial year, we are targeting around 300 plus, maybe 330, 340, whatever there will be. The figures will be there. And as I already told that we are very particular about the profit margins. So we are expecting to sustain the profit margins near to the percentage which we are getting as on date.
What are the biggest risks facing the infrastructure sector today?
I would say the war which we just recently, which is recently ended as. So the war was there. Every infrastructure project was getting slowed down due to that condition. But nowadays, everything is perfectly fine. Everybody is moving on.
How much EBITDA margins do you see in FY27?
Okay, Manishji, would you like to answer this question?
In the last financial year, around 15 to 16% EBITDA margin were received. But definitely we are increasing this figure because we now focus on the government projects, solar as well as private. So definitely 1 to 2% increase in the financial year 27.
The second part, Mr. This anonymous attendee is asked about that the 12 crore the loans and advances. See, these advances are for our subsidiaries. We have invested in our subsidiaries through equity and through loans.
MLBEMA_XPWD identified by Truecaller.
With the IP proceeds.
With the
Yes.
IPO proceeds now substantially deployed, what is your capital allocation priority over the next 2 to 3 years? Working capital, RESCO investment, base opportunities, or expanding execution capabilities?
See, if you will see our IPO mandate, the 30 crore of the total IPO proceeds was for working capital. And definitely this will be contributed towards working capital only. And our past capitals or the loans, everything was deployed towards the working capital, except few percentage which has been invested in subsidiaries for RESCO investments. And as on date, if we will get more RESCO projects on a good PP rates, so definitely there will be a mix of equity and debt. So if I'll say that 15-20% of the total projects could be invested into the equity, and remaining portion 75-80% can be arranged from debt in that particular RESCO company. So major chunk of our capital as on date or the IPO proceeds is invested in the working capital.
What is your long-term target for return on capital employed and return on equity?
Okay. So in Manishji, please state the percentage which we have already the received in last financial year for ROEC.
They are asking for target for FY27.
Yes,
We are
yes,
targeting
because
around 25 to 30% on both sides, ROE and as well as the return on equity.
because last year we already received 25% of the return on capital employed, and yes, it will be increasing in this financial year by adding some profits in the company. Yes.
Out of our trade receivables of 52 crore, how much is more than 6 months?
Very less, very less. Manishji, any
Around,
specific number? Yeah.
more than 6 months, around 10 to 12 CR, or definitely 15 CR, because in the private cycle, we have received at the time of the invoice only 60 to 70% payment, and remaining received after the installation of the plant and completion of the work. So sometimes work are delayed for more than 6 months or 4 to 5 months. So as on it figure are around 15 CR, which are more than 6 months.
EBITDA margins remained healthy despite raw materials inflation because of price variation clauses. If commodity prices remain elevated for an extended period, how much of your order book remains protected?
See, I already told you that the government project generally having this price variation clauses, and the order books of government from is around 40%, so 35-40% is already secured. This percentage could not be changed because of the awarded works is already defined here.
Do you intend to leverage your existing solar EPC relationship to cross-sell base solutions, or will this require building a separate customer base?
Self-base solution. Will this require building a separate customer base? See, base is a integral part of solar only. So there will be a chance of implementing base on the same solar plants which are already installed. There will be a chance because maybe there will be a mandate of you must have to install 10% or 20% of the base against the total solar quantum you already installed. So yes, the customer base could be same and could be separate.
Are you partnering with DISCOMs, EPC contractors, or solar equipment manufacturers to participate in projects under this scheme?
Definitely. I mean, this is our core area.
Battery energy base have been identified as strategic opportunity. What specific capabilities or partnerships are still required for this business becomes commercially meaningful?
See, right now, government policies are required. the picture is not very clear because, I mean, China is way ahead in BESS and India needs to cope up. So government policies like VGF support, viability gap funding support, need some clarifications, and maybe government is working hard, I know, and in next financial year, that means 27-28, we will have some good BESS policies so that the BESS infrastructure increases, and this will create a lot of opportunities like solar.
Investors, you can raise your hand or you can drop your questions in the chat box. What would you consider a successful FY27 for current infra projects, both operationally and financially?
Growth and pet margin,
Yes.
just two things.
As electrical EPC gains a larger share of execution in FY27, should investor expect margins to remain stable or normalize?
Yes, obviously. I think yeah, please.
Investors, you can raise your hand or you can drop your questions in the chat box. How do you view long-term opportunity in BESS compared to traditional infrastructure and renewable EPC projects?
This BESS is more or less like, I mean, solar. So we will have both opportunities. Like some players would want to work as an EPC player, and in some cases we'll have that RESCO model. So I believe the future belongs to BESS only. Next 5 to 10 years would be only BESS, and less of solar.
Investors, next question, please. So I think we have covered most of the questions, and if there are no further questions, shall we conclude the meeting?
Yes.
Thank you everyone for your participation, and thank you, sir. Have a wonderful day, everyone. If you have any further question, you can reach out to us at research@kirinadvisors.com. Thank you.
Thanks, Kiran, and thanks,
Thank you.
Bhargavi Patel. Thank you.
Thank you,
Thank
everyone.
you,
Thank you.
sir.
Bye-bye.